For most traders, sideways markets considered some of the hardest price action to trade. So most traders just avoid this price action and trade only in trending markets. But we know the biggest moves come from sideways ranges. So if you want to make a career out of trading, you need to know the principles I'm going to share with you in today's video, so that you can master trading sideways ranges. Just a quick reminder before we get into the video, NJAT Missing Pieces is going to be out very, very soon. Make sure you're following us on Instagram so that you can know as soon as that is uploaded. If you're finding that you keep going on losing streaks or you can't get past break even, this series is going to massively help you to understand exactly where to look for your trades in the highest probability locations on the chart. We're already seeing the impact of this information inside NJT. We've got Josh, who just passed his second funded account at 50k. We also got ET on the beat last night, made £2,000 for a trade. He seems to be making £2,000 every day at this stage. So it's great to see the information that we're putting out there really impacting people in a positive way. We're also going to have a brand new website for you guys as well. And we got something else coming inside the community that's going to really impact you and help you to get over those technical and psychological hurdles. You can purchase those using the link down in the description of this video or go to notjustatrade.com. If your trades normally look a lot like this, where we see a trending market condition, we get those higher highs and higher lows, and we get those really nice swings between A to B point. These are really good opportunities to play when price pulls back into that 50% area, and then you look for your sideways range around the 50% here, and you play range, initiation, mitigation, continuation, and you continue the trend, right? We've got a very clear direction in the market. You trade with that direction, and you're just looking for intention in that direction. Again, a lot of your stops can be above the range high. I know quite a lot of you guys trade like this, where you trade the reaction, and then you're trading those trend continuations, and you're always looking for that positive risk reward. This is a great strategy, but it's only a great strategy in a trending market. And we know the market only trends around 30% of the time. So what about if we apply this same strategy into a sideways ranging market? This is where a lot of traders seem to get caught taking a lot of losses because they're trying to apply their trending market strategy to a sideways ranging market when they follow different principles. So if we just look at price here, where we would understand that this is a sideways ranging market is around this point here. Because price has seen this initiation here to the downside. This would be considered the pullback and continuation. When we don't continue and take out that low and we start to break here to the upside, that's where we know that price has started to move in a sideways ranging market. Up until this point, we can apply on our trending market system and we can get involved in continuations. Now, this is where we need to make the switch. Now, a lot of traders will find the highest point to the lowest point of the sideways range. And what they'll be doing is they'll be looking for every single range that they can play around the 50% area or premium and discount area where they can look to take those trend continuation setups in the market. Now, this is not a good strategy inside a sideways ranging market, especially if we look on the other side as well. There'll be ranges inside here, initiation. Traders will be looking at discounted pricing to buy these continuations to the upside, looking at all of these ranges to try and play reactions out from. And a lot of the trades will most likely look a lot like this. You're trading the reaction here, stop goes below the low and you get taken out. Then you play the next area, you get taken out, and then price again moves in that area. And then we move down to the edge. Here, you actually get the reaction and that one ends up playing out. So instead of going through that stress and going through all of those loss streaks, which can be quite frustrating when you do have a very good strategy when it's trending, we add a simple fix. One simple tool that we can use that's going to change our results trading a sideways ranging market. Of course, we need to understand what a sideways ranging market looks like. That's what the Missing Pieces course is for, to help you identify what a sideways range looks like. And it follows very, very specific rules, and you'll be able to identify that very quickly. But if we apply on our framework now and we use different frameworks, so instead of looking at that 50% area and just looking at our general discounted pricing and premium pricing, actually let's split this area up into 4 parts. This is what we call our location concept. And this is only for sideways ranging markets so that we can focus our eyes on the highest probability locations inside a sideways range. Now, if we only looked at the top 25% and the bottom 25%, and we only decided to trade in these locations when price got here, can you apply on the system that you use now in these locations that's going to give you a higher win rate or an increased strike rate? Now, for most people, the answer to that question is going to be yes, because you're trading at locations where price is moving away from these locations and it's not coming back. So let's just take on RIMC at these locations. Well, we have a sideways range that's created here where prices moved sideways before we broke out here to the downside. Now, if we extend this area over to the right, and this becomes our location in the future, that when price comes back up into the edges, which is the top 25%, and we understand that price is in a sideways range, this is going to be a high probability location that we can start to play as a continuation here to the downside. Now, obviously we use RIMC, so we'll be looking for ranges at the edges, followed by an initiation that's created a low, and then we can play price back into that point of mitigation here in the future at a good location. And then we have a very clear target to the downside, which is always going to be swing highs and swing lows. So we have a clear direction from this point of mitigation all the way down into this low down here. Now, this is just before even getting into entries. All we're doing is looking at highest probability locations on the chart based on the structure, so that you stop getting into trades where you've seen an A to B movement and you're looking around the 50% or just above the 50% area, or just above that area because there's another location above there that you can trade. And you're focusing on very specific locations on the chart where you know that price has to react out from, and it's not going to come back into that location. Now, we call this middle area here between this edge and this edge here, we call this area the slaughterhouse. The reason we call it the slaughterhouse is this is where you're going to get taken into a lot of your positions and get taken out of a lot of your positions very quickly, because price is going to target the best locations inside a sideways range, and it's going to use the middle of the range to generate liquidity in order to target once we've gone from the edges. So when we think about that concept, all of the lows or all of the highs that are created in the middle of the range or around the 50%, anywhere that's not the edges of the sideways range, these are all going to be used to create liquidity, which means they're going to be used to create targets for price to use to continue in that direction until we do hit an edge. So you see all of these areas, all of the highs and the lows that we can see that are created around 50%, were eventually taken out or eventually targeted after we've hit the edge here. So we want to start to position ourselves inside a sideways range where we're more likely to win and less likely to just get taken out and used for liquidity. So that's the basic concepts that we utilize when we're in a sideways ranging market. Now, let's take this a step further, right? So we know that it's not a sideways range until we reach this area here. So we know that we're going to be looking up here for our reaction. Now let's read the price action as price comes into this area. And this is exactly what we're going to do. We don't have to trade this as a reaction. I think a lot of traders look at trading and they think, well, there's a range to the left, so I have to put my entry here, my stop above, and I trade that as a reaction. That's one way of trading, and that's not the best way of trading. We can wait for reactions. We can wait for price to show us its intention again, and we can play those pullbacks and continuations to the downside. So this is what we always look for. We wait for price to show us its intention again at that location, and then we play the continuations to the downside. Now, Chucks will zoom in here on the 1 minute chart and play continuations here to the downside to maximize the risk to reward. For me, I'm looking for candlestick formation. So I'm looking for fractal highs and fractal lows. So this is a fractal high that's printed here. And the reason I look for fractal highs and fractal lows is these are sell orders coming into the market. If the big banks are selling at a good location and they've showed us their intention to the downside, then all I need to do is just follow along with that intention. So that's one fractal high that's printed here, and we can see that that broke structure here to the downside. And the break of structure here is showing intention for lower prices. So then we can see that price created an A to B price range here, A to B, which is the start of a trending market, but it's not a trending market because we don't have a lower high and a lower low printed. So we're still in a sideways range at this point. So what we can do is we can apply on our location concept again to this A to B point. And what we're going to do is we're going to look at the highest probability locations, which again, you guys should know by now, is that top 25%. Now look how specific the area can get on the charts. We focused our area on the higher time frame sideways range to this top 25%. Now when price has showed us its intention again, we focused our specific area into this very small reaction area up here, where we want to be looking to take our trades. That's how we're finding the highest probability locations on the chart, using the structure and the location concept together. These are all things that you're going to learn in the missing pieces seasons. Now, what do we get at this top 25%? Now, I'm not just going to trade this as a reaction. You could trade this as a reaction by just putting your entry at the 25%, stop above the high, and playing that as a continuation to the downside. I wait for more. I want price to show me its intention again, at this location. So what do I want to see? I want to see a fractal high. Now we see a high, a low, we run above that high into the point of mitigation, and then I see my entry candlestick pattern. So for me, I enter after price has showed its intention, and I'm using a fixed stop loss, which is 10 pip stop loss, and I'm playing the direction of the market with a positive risk to reward. So where most traders will be looking for that A to B, they'll be looking in the 50% premium discount, and they'll be getting involved in trades that look like this, where they get reactions and they eventually get stopped out. We're focusing our eyes on the specific areas because we know a trend hasn't formed yet. Now, for example, if we haven't got involved in that entry, we can see that price reacts from that area that we would have looked at here, and we break structure here to the downside and we create a new low. Now we can use our 50% continuation area because price isn't in a sideways ranging market anymore. Now we're in a trending market. This is where we can apply on our 50% continuations, and we can trade the sideways ranges that are presented at 50% and play these as continuations, either as those reaction points with our stop above the high, or if you want to take this as a candle reaction with a larger stop and just play the overall direction, which is how I trade price. Now it makes sense to play that as a trend continuation. So it's structure first, and then we focus on the location. Because if we understand what structure we're in, we understand the exact locations that we're going to be looking for on the charts, and they're different in a sideways ranging market versus a trending market. So it's really important to understand the structure first, then we apply on our framework, and then we know exactly where to look on the charts for the highest probability trade. This is so that we don't get caught up trying to trade the middle of the range when we think it's a trend, and our processes can be aligned with how the market actually works. These are the facts of the market. These are not just our theories. The market is showing us that these are the best locations based on how it delivers. So then we continue our trends. We create a lower high and a lower low. Now we're not in a sideways ranging market anymore. We're in a trending market. So if we take the highest point to the lowest point here, where does price react from? It's not going to come all the way back into that top 25%. This is again where we start to look around that 50% area for those continuations. So if you are taking a lot of losses, it's not that you're taking a lot of losses because your system doesn't work in a trending market. It's that you're taking losses trading a sideways ranging market. So it's a simple shift in your mind to focus on a different market structure and understand what the market structure is. And then you can trade your strategy a lot more effectively. And this is the same with every single sideways range. As soon as you can identify that price is in a sideways ranging market, then you can start to add on your framework and you can stay away from the middle of the range. Again, here, a lot of traders are going to look at price and they're going to say, well, if price gets into premium or discount, this is where I'll look for my continuations. Why? Because we've created that A to B, we've broken structure. Some people look at the charts and say this is a change of character, and then they're looking for the range here at a low price and they're putting on the entries here and they're getting stopped out of the trades because they're expecting that price is going to continue here to the upside. Now, because we understand a sideways ranging market, we're not going to look in those areas for those continuations. We're going to understand how a range moves and how it's presented on the charts. And we understand the overall direction and where price is targeting the edges on the higher time frame, which makes it easier to trade with that direction. We're not looking for changes in direction until price gets into these bottom 25% or these top 25% areas. So when we're trading away from these locations and we're seeing new sideways ranges and we can apply on our location tool, this is where we can find really high probability trading locations inside these sideways ranges, playing a continuation of that direction into the next edge. So it's the principles that's the most important. It's understanding the structure, then it's applying on the framework, trading with the direction that we're seeing into the next edge in a sideways range. If this is a trending market, and this is a higher time frame trend, all we're going to do is look at exactly the same thing, but we're going to be looking for price to target the lows instead. So we're going to be looking for our 50% continuations into the swing low. Now, in a sideways range, we obviously have swing highs and swing lows that can be targets, but we also have the edges that can be targets. So we can trade with that intention into the edges. In a trending market, there's only a swing high or a swing low. So price is only going to target a swing high or a swing low. So when we get into those 50% continuations, we have a clear target down into the swing low. These are all concepts that we teach you at NJT, and these are all concepts that we break down inside the Missing Pieces season so that everyone is focused on exactly the same areas in our community. So when we're in our live chat on a daily basis, everyone is all focused on trading exactly the same locations because we all trade with the same information and the same intentions. And that's really important to create a really strong community of traders that are actually progressing towards taking trades in better locations and seeing more winning trades. And that is our whole focus with NJT, is to get your eyes focused on the best locations in the chart and to catch more winning trades so that you can pass those prop firm challenges and you can build your own accounts. Make sure you check out the links in the description of this video. Make sure you leave us a like as well and comment if you did enjoy the video, and we'll catch you guys on the next one.